Welcome back to Investing Talk Podcast. We are zeroing in today on a stock that has achieved, well, near mythical status in the last year. I'm talking about its explosive performance in the nuclear fuel sector, Centrus Energy Corp. The question that has been landing in our inbox constantly, given the massive 401% run-up is Centrus Energy Corp a good time to buy now? This asset is highly volatile, and it's tightly tied to national security interests, which makes the analysis pretty complex. We've pulled our sources, financial reports, technical charts, geopolitical context, to give you a clear picture. And hey, if you find this useful, please hit that subscribe button, give us a like, maybe leave a comment below. Also, if you want us to look into a specific company next, just drop that ticker in the comments.
Yeah, and our mission here is really to move past just the headlines. We need to dissect the actual foundation of Centrus Energy Corp. So sifting through the financials, the momentum indicators, and critically, the whole geopolitical mandate to understand exactly what's driving this phenomenal run, and maybe what major risks are currently being overshadowed by that momentum.
Okay, let's unpack the recent financial reality then. Centrus has certainly delivered on the top-line metrics. Looking at 2024, revenue hit $442.0 million. That is incredibly robust growth. Came in 38.04% higher year over year from $320.2 million. They are significantly outpacing peers here.
Right. That revenue surge tells a great story. Market share capture, successful contract fulfillment. It's all there. But here is the profitability puzzle you mentioned. While that top line soared, 2024 earnings actually declined.
Yeah,
down 13.27% year over year, settling at $73.2 million.
Okay, that conflicting data is crucial. Revenue up, earnings down. For someone learning, what does that instantly signal? Is it a red flag about cost management?
Well, it indicates margin compression, definitely. But we suspect it's more of a deliberate, maybe short-term trade-off, like a strategic decision rather than just poor management. Think of it this way. Centrus is a first mover, right? In this highly complex, critical technology, high-assay, low-enriched uranium, or HALEU, they are incurring heavy upfront costs right now. They're rapidly scaling specialized staff, securing long-lead supply chain materials, and absorbing those initial high costs related to starting up HALEU production, all to secure future dominance.
Okay. So the market is essentially looking past this current quarter's cost absorption and betting on the massive high-margin government contracts that will only be unlocked if they secure this early dominance.
Precisely. And the long-term data kind of supports that view, too. Net income for the last 12 months, the LTM, was $104.8 million. So that shows overall strong gross and net margins when you smooth out those early 2024 charges. And the forward-looking analyst consensus, it fully expects further revenue and earnings growth. It's all predicated on favorable U.S. and international nuclear policy continuing to drive demand.
That sounds like a company operating with a long-term strategic map.
Yeah.
Let's talk about their war chest then. What does the balance sheet look like when they need to rapidly build out new facilities?
Yeah, the balance sheet provides tremendous confidence, actually. They hold ample liquidity and moderate leverage. As of Q2 2025, their consolidated cash balance was $833 million. That liquidity is absolutely vital for a company facing, multi-year, multi-billion-dollar industrial expansions. It gives them flexibility for rapid scaling and significant technology investment without needing to dilute shareholders right away.
And we should note they keep that cash flexible. They choose not to pay a common dividend. In a sector where capital expenditures are just massive, holding on to $833 million for growth and potential buybacks, it's likely the only smart play, right?
Absolutely. They are prioritizing future industrial capacity over that immediate yield. Makes sense.
Now, here is the true competitive moat, the thing that underpins the entire valuation, HALEU. We've defined it, but why is this high-assay, low-enriched uranium factor so defining? Standard uranium fuels have been around for decades. Why is Centrus Energy Corp dominant just because of HALEU?
Okay, yeah, this is where the synthesis is critical. Standard low-enriched uranium, LEU, is sufficient for existing large traditional nuclear plants. We know that. But HALEU is the advanced fuel for the next generation, specifically for small modular reactors, or SMRs. The global future of cleaner energy and, frankly, energy independence rests heavily on these SMRs.
And they need HALEU to function. Simple as that.
Exactly. SMRs can't run on LEU. So Centrus holds the exclusive technical capabilities and the regulatory approval to produce HALEU domestically. That makes them effectively the only domestic supplier for the entire future infrastructure built around these new reactors. This is why U.S. government policy is so focused on them. It's about breaking reliance on, well, geopolitical rivals for central national infrastructure.
And the recent progress on their government contracts seems to confirm the strategic importance, right?
It does. They completed phase 2 of the HLEU contract, delivered 900 kilograms to the Department of Energy, and importantly, immediately following that success, the DOE exercised a $110 million portion of phase 3. That extended that contract period out to June 2026. This isn't just revenue, it's confirmation. Confirmation that they are essential to U.S. strategic energy security.
Okay, so we have healthy financials, strong liquidity, and this dominant geopolitically critical moat in HLEU. But the stock price performance, it feels wildly disconnected from traditional PE or valuation metrics. The charts are showing, I don't know, nothing short of absolute mania. Looking at the data as of October 2025, the stock is in a really pronounced bullish trend, up over 70% in just the past month.
And if you zoom out, the scale is just staggering. The year-to-date return is a massive 401%. That results in a total shareholder return of 565% over the last year. This isn't typical industrial growth, you know. This reflects a market pricing in massive geopolitical tailwinds and almost monopoly-like potential.
Yeah, the 52-week range tells the story. $49.40 up to $389.41. Recently hitting all-time highs. For listeners tracking the technical levels, what is the price action telling us about the psychology driving this massive valuation?
Well, the psychology seems pretty simple. Accumulation. Key support levels are holding firm around $350, $360. And they recently broke major resistance zones in the $380, $390 range, and crucially on high volume. When a stock breaks all-time highs on high volume like that, it signals conviction. Technically, this action supports a potential next 3-month range of, say, $360 to $410.
Wow. So that suggests the technical analysts see significant runway even after this massive surge. But let's look at momentum indicators. Are we seeing signs of maybe short-term exhaustion setting in?
We are not seeing exhaustion, no, but we are seeing elevation, definitely elevation. The moving averages, both the 50-day and the 200-day, are strongly upward sloping. That confirms a sustained, powerful uptrend. The Relative Strength Index, the RSI, it is high, sitting comfortably in the 68-75 range.
Now, hold on. For most stocks, an RSI near 75 would scream overbought or time to sell. Why isn't the market reacting to that high technical reading here?
That's a great point. In a typical stock, yeah, that RSI would likely indicate an immediate pullback is due. But in a geopolitical momentum play like this one, it suggests the stock is simply establishing a new, higher baseline of value. It's different. It confirms institutional buyers are holding firm and accumulating. The volatility is significant, yes, absolutely. But the data seems to confirm this reflects institutional accumulation, not destabilizing short-term retail speculation. They are betting, essentially, that the national security imperative is stronger than any traditional technical signal.
Okay, it's clear that institutions are driving the price, betting on the future. But this leads us directly to analyst sentiment, which seems weirdly disconnected. The stock is currently trading in the 380s, right? Yet the highest analyst 12-month price target is only $310. If the stock is trading $70 above the consensus high target, why is the consensus still a buy or moderate buy among, 11 to 13 analysts? Are the analysts just completely lagging the story?
That is the crucial tension right now, isn't it? The market is pricing in speed and political necessity. The analysts traditionally tend to lag when geopolitical tailwinds are this strong. They have to. They are required to use conservative models based on confirmed contracts and confirmed execution timelines. The market, however, is pricing in flawless execution plus the potential for multiple, massive, unconfirmed future catalysts.
And to be fair, Centrus is backing that up with performance so far. We saw recent Q2 earnings, where Centrus Energy Corp exceeded consensus EPS by large margins, reported $1.59 versus $0.83 expected. That kind of execution must be giving the market confidence to look past those official price targets.
Absolutely. Now, looking ahead, there are 2 key upcoming catalysts that every investor really needs to watch. First, the Q3 earnings report. It's anticipated on October 31st, 2025. This will be the first chance to scrutinize how those Phase 3 contracts are being executed and to get forward guidance.
And the second date is tied to that crucial HLEU expansion, correct?
Yes, that would be the Department of Energy's next funding decision.
Yeah.
It's related to the HARU expansion. That's anticipated around December 10, 2025. That decision could potentially unlock the multi-billion-dollar plan Centrus announced to expand its uranium enrichment facility in Ohio.
Right, that Ohio plant is the key, isn't it? It moves them from being a specialized sort of startup provider to a foundational national resource, securing long-term market leadership and completely disrupting the U.S. reliance on foreign imports.
Precisely. And beyond those confirmed dates, the rumor mill is spinning fast. You hear things. Market chatter suggests the company could announce new multi-decade U.S. government supply deals. That would be huge. There's also speculation about a potential joint venture with defense contractors. Unconfirmed, of course, but the buzz suggests such a deal could add an immediate, say, $50 to $100 million in annual revenue just by linking them directly into the defense supply chain.
And we also hear rumors pointing toward potential interest from foreign utilities. I mean, who desperately need non-Russian HLEU supply, or even inclusion in additional major nuclear or ESG ETFs. The market is clearly anticipating a whole series of positive surprises to justify this current price.
Which naturally brings us back to the risks. Because there are risks. For a company so tied to national security, the risks aren't standard business risks. They are geopolitical and operational risks. First, concentration risk. They are heavily reliant on a few key government and utility contracts. Any major shift or delay in U.S. policy or funding could immediately shatter near-term results. They are not, a diversified conglomerate.
And the second risk relates directly to their ambition. Execution risk. They need to go from specialized production to industrial scale, and fast.
That's the entire tension right there. The timeline for ramping up new facilities, especially that Ohio plant expansion, is incredibly critical. Building a massive, highly complex, government-approved factory is never easy. Never. It's vulnerable to long lead times, construction delays, cost overruns, all the usual suspects, but amplified. Management has to execute flawlessly, essentially, to meet the expectations currently baked into that 401% YTD price surge. Delays aren't just industrial setbacks here. They become national security concerns. And the market would punish that heavily.
So what does this all mean when we synthesize the financials, the technicals, the geopolitics? The overall investment thesis summarized by the sources is unequivocally bullish. I think you said around a 9 out of 10. The thesis cites explosive growth, sector dominance, all driven by these geopolitical tailwinds favoring domestic supply of a critical fuel. The stock is viewed as attractive for both short-term trading, leveraging those Q4 2025 catalysts, and maybe as a long-term holding based on its HLEU dominance.
Yeah, and if we connect this to the bigger picture, the market has clearly already accepted the high valuation. Why? Because the need for domestic HAU is deemed a national necessity, full stop. Therefore, the entire investment thesis now really rests on the successful execution of these massive government-backed contracts and the speed of that Ohio facility expansion. So this raises an important question you should keep asking yourself. Given the stock's already significant technical surge, will the overwhelming geopolitical importance of domestic AGU continue to outweigh the inherent massive execution risks and the volatility associated with scaling up such a highly strategic national asset? That tension, between national need and industrial delivery, that is the single most important factor to track in the coming quarters.